Hey guys, hope you're well. Hope you're well. Have you ever imagined being able to trade any token instantly for another from anywhere in the world? It sounds almost too good to be true. Without the need for traditional financial intermediaries like banks or brokers, it seems impossible. But today it's a reality for millions. In 2018, Uniswap changed the game by introducing an innovative solution called automated market makers, or AMMs. This idea completely reimagines how exchanges should work. Let's unpack this incredible innovation together. First, let's set the stage. Prior to Uniswap, trading tokens involved centralized exchanges or order books. To make a trade, a buyer had to find a seller willing to sell at a given price. This process wasn't perfect. Often there were few sellers for certain tokens, meaning low liquidity. This means that if you wanted to buy a token and there were only a few sellers, the price of the token could go up significantly, because those few sellers could name their price and people wanting to buy would have no other choice. Sometimes there were also many buyers for a particular token. In this case, the price could drop because the abundance of buyers would drive competition among them. However, this method wasn't very efficient either. Buyers and sellers had to be a perfect match. It was also somewhat restrictive. Not everyone could set up a trading account, especially if they didn't meet certain requirements. Then along came Uniswap in 2018. Its approach was revolutionary. Instead of matching orders, Uniswap employed liquidity pools. Anyone could deposit their tokens into these pools, making a portion of their holdings available for trading. The magic happens when a trader requests to swap one token for another. The trade occurs directly with the pool. So instead of waiting for a counterparty, traders get matched with the pool. An algorithm keeps the price of the tokens in balance, ensuring smooth transactions. Let's see how this works in practice. Imagine two friends, Alice and Bob, who decide to use Uniswap. Alice has some Ethereum that she wants to trade for USDC, and Bob has some USDC he wants to exchange for Ethereum. They each deposit their tokens into the same liquidity pool. Now let's say Bob decides to sell his USDC and buy some Ethereum. His trade goes through the pool. So now there's a bit less USDC and a bit more Ethereum in the pool. How does the system decide on the price for Bob's trade? Here's where the algorithm comes in. At its core, the AMM algorithm uses a simple equation, x times y equals k, where x and y represent the quantities of the two tokens in the pool, and k is a constant. Whenever a trade occurs, the algorithm adjusts the prices of the tokens in the pool to maintain this balance. So as Bob buys Ethereum with his USDC, the algorithm increases the price of Ethereum in the pool. This way, if Alice wants to buy USDC with her Ethereum, she gets a slightly higher price than Bob paid. That tiny difference in price is how the pool makes money. After each trade, a small fee is collected and shared among the liquidity providers like Alice. This incentivizes people to add liquidity to the pool and helps to keep the market running smoothly. In addition to this simple yet effective pricing mechanism, AMMs introduce a range of benefits. One of the most significant advantages is constant liquidity. Unlike order books that rely on matching buyers and sellers, AMMs always have liquidity available. This means traders can execute their trades instantly without waiting for a counterparty. Also, AMMs are permissionless, which means anyone can use them without needing approval from a central authority. This opens the door for more diverse and inclusive markets. Moreover, AMMs don't discriminate based on location. As long as you have an internet connection, you can participate. Let's revisit the example of Alice and Bob. Remember how Bob was selling his USDC and buying Ethereum? With every transaction, the pool becomes a bit more concentrated in Ethereum. This means the price starts to favor USDC. So if someone wants to buy Ethereum now, they'll have to pay a higher price. That's the beauty of an automated market maker. It uses an algorithm to dynamically adjust prices based on supply and demand. No need for human intervention or complex order matching. The benefits of Uniswap and AMMs have been immense. Investors and traders flocked to this platform. In fact, in 2021, Uniswap v3 processed a whopping $42 billion in total value locked, TVL, cementing its position as a major player in the DeFi space. AMMs unlocked something truly special: open liquidity. Anyone could become a market maker. Anyone could trade without permission. And this innovation inspired numerous copycats. It's safe to say that AMMs shook up the entire crypto industry. Today, there are hundreds of AMMs out there, each with its own twist. SushiSwap, for instance, entered the scene with lower fees, attracting a wave of new users. Other platforms like PancakeSwap and QuickSwap have expanded to multiple chains, boosting liquidity across different ecosystems. Some AMMs have even ventured beyond tokens, facilitating the trading of NFTs and other digital assets. However, AMMs aren't without their challenges. There are risks involved in trading and providing liquidity. Impermanent loss is one such concern. In simple terms, impermanent loss occurs when the value of the tokens in a liquidity pool changes. You can think of it as a temporary loss that can happen when you provide liquidity to a pool and the prices of the tokens change. This can lead to a decrease in your overall holdings if you don't exit the pool at the right time. However, it's important to note that this loss is only realized when you remove your tokens from the pool. If you hold on long enough, the loss can become permanent, hence the term. To illustrate this, let's imagine you and a friend each put $1,000 worth of two tokens, Token A and Token B, into a pool with a 50-50 weight. Over time, Token A appreciates in value, while Token B stays roughly the same. This means the pool becomes more concentrated in Token A. If you check in periodically, you might notice that your share of the pool is increasing. However, if you check back after a significant price movement, you might find that the value of your holdings has decreased despite your share of the pool remaining the same. This decrease in value is your impermanent loss. Another challenge is the high gas fees on Ethereum. Gas fees refer to the cost of executing transactions on the Ethereum network. These fees can be quite substantial, eating into a portion of your profits. This issue has driven many users to explore alternative blockchain networks with lower fee structures. Luckily, Uniswap and other AMMs have addressed this by expanding to multiple chains. Think about it. The popularity of Uniswap and other AMMs has been nothing short of phenomenal. Since their inception, they've opened the floodgates for a wide range of new projects to emerge. It's almost as if there's been a domino effect where once one project gained traction, others started popping up left and right. It's a thriving ecosystem. Let's take, for instance, the rise of Curve Finance, a platform that caters specifically to stablecoin trading. Then there's Balancer, which offers more customizable pool options for traders. Each of these projects brings something unique to the table while building on the foundation laid by the pioneers. But this explosion of activity hasn't been without its downsides. It's no surprise that with great popularity comes great risk. Many projects, especially in the DeFi space, have fallen victim to exploits, hacks, and security breaches. This highlights the importance of continuous vigilance, robust security measures, and a thorough understanding of the risks involved in decentralized finance. If you enjoyed this video, please leave a thumbs up and subscribe to our channel for more content like this. Thank you for watching, and we'll see you next time.